Main Street Capital, ticker MAIN, is the best performing business development company of all time. Since going public in October of 2007, their stock has delivered an average annual return of 17.83%, which crushes the S&P 500 as well as every other BDC for that time period. They're one of only a couple of BDCs that have never gone through a dividend cut, and they're the only company in this sector to have not cut their dividend during the financial crisis. Prioritizing more equity positions in their portfolio as opposed to mostly first lien debt like almost all of their peers, they've done a fantastic job at picking good companies to invest in, and their results clearly show that. As we all know at this point, Main Street Capital has had a brutal month so far. As of the making of this video, shares of Main are currently down over 15%, which I know a lot of investors are not used to seeing with this stock. It's been a fantastic grower for a BDC, as most companies in this asset class don't experience this consistent amount of share price appreciation. And likely all of my viewers know that it's not just Main Street Capital. The entire BDC sector has been falling hard over the past couple of weeks. But Main Street Capital has fallen the hardest when compared to other companies in this sector, including Ares Capital, Hercules Capital, and Capital Southwest. So this is going to be a good opportunity to talk about why this sell-off is happening in the BDC sector and why it's more intense for Main Street Capital. We'll also look at a major hit piece that came out against this company a couple of months ago, which has raised some concerns about Main Street. We'll see if this report, or at least some things mentioned in this report, is causing Main Street to fall so hard. So first off, why are BDCs falling? It's because people are less optimistic about these investments in a falling interest rate environment. These companies stand to lose interest income from their debt portfolios because most BDCs hold a large amount of floating rate debt. When interest rates rise, then BDCs collect more money from their loans. When interest rates fall, then they earn less money from their portfolios. There are strategies that these companies employ when interest rates start going down to avoid dividend cuts. BDCs have been through falling interest rate environments before without slashing their dividends. But the market seems to be anticipating a much more difficult environment for them going forward, and so many investors have been unloading them to try and find a quick profit elsewhere. But since BDCs started falling in share price a couple of weeks ago, we haven't seen any BDC report really bad earnings. Most, with a couple of rare exceptions like Horizon Technology Finance, are still covering their dividends. And in fact, if your BDC holdings are still paying special dividends, that's a good sign that things aren't terrible right now. Even if the supplemental dividends do go away, that's not a sign that you should sell your BDCs. Capital Southwest, Hercules Capital, Blue Owl Capital, and of course Main Street, among others, are still paying special dividends. Now don't get me wrong, things are going to get harder for BDCs in the foreseeable future, and it's very likely that we will see a couple of them report dividend cuts. But the only thing that we can go off of right now are what these companies are reporting to us, and as of right now, most BDCs are currently still doing fine. It's something that we will have to keep monitoring though. Let's now turn our attention to Main Street specifically. Like I mentioned, and again you likely know this, their stock has fallen hard, much harder than the typical BDC. Recently, there was an attack piece published on this company by a company called Jehoshaphat Research. They published a lengthy short report on why they believe this company is doomed and are predicting a sizable dividend cut. It's a 97-page document that's full of all kinds of accusations, from fraudulent accounting practices, to Main Street overvaluing their portfolio, to accusing Grant Thornton of turning a blind eye to their problems. So we're going to take a look at some of the biggest arguments against Main Street Capital that were made in this Jehoshaphat report. I need to start by saying that if you are going to criticize a BDC, then Main Street Capital, in some ways, was kind of an easy target. Not necessarily because there's something wrong with them, but because their stock was trading at its highest premium ever when this report came out. This is almost always the case for Main Street Capital, because the market has always been willing to pay more for higher quality. But the premium Main was trading at before this sell-off took place was at historic levels. The way you determine if a BDC is overvalued or not is by comparing its share price to its NAV per share. Less than 2 weeks ago, Main was trading at a 93% premium. This was by far the largest premium in the BDC sector, and it was actually close to 100% not too long ago. Even after this sell-off started, it's still more than 70% overvalued. This, in my opinion, is why Main has fallen the hardest. It was the most overvalued stock in this sector, and now that investors are turning away from these investments, Main will fall harder in share price. So if you expect a sector-wide sell-off to take place, then all of the overvalued stocks in the sector are going to fall harder than average. That's why I think Main Street Capital was kind of an easy target if you expect BDCs to sell off. So let's go ahead and take a look at this Jehoshaphat report. It starts out with a terms of use page, basically saying it's not financial advice, just to cover themselves. It's basically a cop-out if their predictions don't play out. Now we get to the first page of their report in which they discuss why they're shorting it. And already on page 1, we can see they made a major mistake. It says, in our analysis, unrealized gains have inflated Main's NAV by around 40% and its EPS and ROE similarly. However, they do nothing to support the dividend, a dividend which is no longer covered by underlying portfolio cash flows and which we think will be cut, just as it was cut the last time internal cash flows fell like this. If you know this company like I do, you're likely asking yourself, when exactly did this dividend cut take place? It doesn't show anything on their website, and it doesn't show a dividend cut on any financial website like Seeking Alpha. That's because this statement is incorrect. This stock has never been through a dividend cut. Now, Main Street is very well known for paying a regular monthly dividend and a lot of special dividends. Their stock has reduced their special dividends, but this is not a dividend cut. They're simply opting to lower the amount of their bonus they're giving to investors. Jehoshaphat Research apparently does not know the difference between a regular dividend and a supplemental dividend. Or they potentially do know the difference and they're just trying to mislead you. Supplemental dividends are a big part of BDC returns. If they don't know the difference between a regular dividend and a supplemental dividend, that's an incredible sign of ignorance, and I'd carry anything they say going forward with a grain of salt if you can't even get this right. But we'll still go ahead and look at some of their major accusations, which they do raise a couple of concerns that I know some people have. The first argument is that Main is reporting a significantly higher fair value over market cost. In other words, this company is reporting that the investments in their portfolio are worth more than what they pay for them, and the premiums that they're assigning to them are significantly higher than any other BDC. We can see for December of 2023, they reported their portfolio at fair value was worth $4.2 billion, and they only paid $3.7 billion for their investments. This represents a 15% premium, which is significantly higher than any other BDC. But this does not necessarily mean that fraud is going on. We all know this BDC has a really long and great track record of making investments for well over a decade. Main Street holds a lot of equity positions compared to other BDCs. It's why their stock's dividend yield has always been lower. They don't hold as much high-yielding debt like most BDCs do, which allows them to see higher growth in their portfolio's value. They also touch on Main Street's rising non-accruals, which is worth addressing. This is causing some people to be concerned about this company, as their non-accruals currently make up 2.1% of their investment portfolio at fair value and approximately 5% at cost. Now, normally, this would be a concern for me as well, but Main Street's dividend payout ratio is still a very comfortable 72%. So this company clearly does a much better job at managing their portfolio and their non-accruals, but it is something I'll keep monitoring. Jehoshaphat also thinks it's very questionable that they use Grant Thornton as their auditor as opposed to a Big Four accounting firm. They ask, why would one of the largest BDCs go with such a small accounting shop? Well, Main Street Capital wasn't always one of the biggest BDCs, and they've done business with Grant Thornton for a very long time. It's not an indication that their auditors are committing crimes or looking the other way. They've just had an excellent relationship with them for many years. And by the way, Grant Thornton is currently the 7th largest accounting firm in the world. Technically not among the Big Four, but definitely not a small accounting shop like they claim. Then they also point out Main Street's share price overvaluation, which I already covered. This was their only solid claim in my opinion, and I discussed why it was trading at such a high premium. Anytime in your life you want higher quality, whether it's a stock or a kitchen appliance, you have to pay a higher price. No dividend cuts, monthly distributions, and incredible NAV growth. These are some of the reasons it's garnered such a high price for a long time. Just because something is overvalued does not mean that you shouldn't invest in something. Only once in the past 7 years was Main trading at a discount, which was very briefly during COVID. Had you not invested back then, you would have missed out on some pretty serious gains. For every other major accusation, in order for it to be correct, it would have to mean that Main Street has been misleading people at best, or committing fraud at worst, for a long time, and I don't see enough evidence to come to that conclusion. If their stock continues to fall along with the BDC sector, then I know Jehoshaphat is going to claim they were right, but they'll really only be right if Main Street is found to be misleading their investors. And think about the impact of that. If Main is committing these acts, it would tarnish the reputation of the 7th largest accounting firm in the world. It's not impossible, but I would need to see more evidence. As for the share price of Main itself, I think it's likely that it could fall further. I would love to be wrong, but at this point, I see no reason whatsoever to sell my position in them. Let me know what you guys think of this report, but with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.